Welcome to the October Wealth Advisory Review. Tonight, we're going to be talking about a number of things with the economy and the markets, as well as starting our education series. And I have been looking forward to this. I'm going to explain more about what brought this on because we had a couple of new attendees a few months back who'd asked a couple of questions. I thought, you know what, this might make a lot of sense. So we're in for a fun time tonight, I believe. Just a moment, as always, the important disclosures that remind you that there is no perfect investment program ever. There's different benefits and challenges to each program that you would look at doing. There are investment issues as far as growth or income, risk tolerance, flexibility, access to income from the program, or access to cash reserve, as well as there are tax issues and legal matters to consider when you're looking at your whole financial planning situation. So as always, make sure you get all the information you need to make good decisions, involve all of your team, whether that's attorneys or CPAs, whoever, to help you make sure you make the best choices for your situation and your family's wealth. As always, we'll have time for questions at the end. If you have any questions, you'll either be able to raise your hand, and some people I can let in, actually let them talk, which is what we love to do. But others, we just have to do a chat where I can answer questions for you that way. Through the chat, and both those will be optional, available. If you have a question halfway through, go ahead and write it in the chat, and I'll be happy to answer it when we get to the end of the material. Tonight, we're going to take a look at the market and economic data for the update. We're going to take a look at the beginning of our wealth education series. We're going to talk about equity investment choices. I'm going to talk with you about some of the differences that we offer here as we go through the year, moving forward into planning and tax management and to investment, risk management, insurance, etc. Talk about how we help people to create, grow, protect, and preserve wealth for themselves, and their family. Also, we're going to talk a little bit more about our Fidelity transition, which is well underway right now. And I'll take time for questions and then update you on the next advisory review. So as always, we take time to look at the markets, what's going on. I don't know if you follow it closely. I do. And so there's a lot going on right now. Let me actually go to the live portion where we can pull up actual economic data. Take a look at it. There we go. So what you're looking at here is the S&P 500. Good. We'll take a look here at a couple of pieces of this. First off, what we're looking at is, why is this not doing my little... There we go. That's it. All right. We're looking here at the data. This is the short-term data, looking at going over, sorry for all that up and down, for the last 90 days or so. Just taking a look at what's happened with the market. You may have noticed or heard that last week we had a bit of a pullback. The market reacted. It's one of those things that we've been looking for. But as always, it has been one of those items that's been very short-lived. For our accounts that have their assets fully invested already, we're very pleased we haven't made any adjustments for those. For clients that have cash, we've held a little bit of cash back, looking for different opportunities. As we've gone through the months, we've taken advantage and put money in at times, not all of it, just pieces of it. And so again, looking at doing that with this account as well, or this time with the month also. Had sort of the witching hour is when this month has lots of different options that get traded, calls, that show for the market going up, puts that show for the market going down, and a lot of those get called and have to be dealt with. And so that may be part of what it was last week, or it could be that what we're seeing here is that the market was reacting to President Trump's 100% tariff on Chinese goods. Again, that is a conversation that's going to be had out over the next few months. I saw something today that said that he felt comfortable they were going to come to a good resolution with China. I don't know if China feels the same, but we'll find out. But as we go forward here, you can see that the market, while it did drop a bit over the last bit of the last 5 days or so, you can see that it has actually come back almost to where it was before. If this continues on, breaks above this previous high right here, I do believe we're probably in for some more growth. Again, I will tell you that every day with the markets, we're watching carefully. Certainly there is a sense, I think, that many people would recognize that the stock market has just continued to melt up and up and up. There have been some concerns about inflation and what the tariffs may have done to cause that. I think there's also concern that The unemployment rate has been slowly, and I'd underline slowly, ticking up. I think there's also concern that the average person feels like their finances, their income, and their wealth have not kept up with the markets. And so, on one hand, they're happy that their 401ks are going up and their investments are going up. On the other hand, they're not so happy that their lifestyle, their income, and their short-term savings and checking aren't showing the same kind of reactions. I think those two pieces cause a little bit of discomfort right now. That may be part of what plays into this as well. Having said that, it does seem like there has been, and for quite a while, to be honest with you, sort of a separation between Wall Street, Main Street, and your street or my street. It seems like the Wall Street has continued to make money, even when the economy itself hasn't always felt as good. And so, again, looking forward here over the next few weeks, if this continues to move forward and up as it has, I think this probably gives us confidence that there's going to be some good times ahead. But I would also say, finally, that the markets kind of sometimes are like the weather. Check with me tomorrow and I'll tell you whether it's going to rain or not. Right now, it looks good, but there could be other information that comes out. And so that's why we watch carefully and keep updating you on what's going on as well. So I know many of you watch carefully as well. And sometimes you call me and say, hey, what do you think about this idea? And we love that. So please keep doing that. Having said all that, now we're back to the S&P 500 here. What I would point out is that it has continued to hold its own right now, even though we had a bit of a pullback. When we look at other factors in the market, I would say that there are some dark clouds ahead, but I think they're pretty small at this point, and there's more blue skies. So we're going to continue on that path. Taking a look at other couple of pieces here. If we look at the markets overall, looking at the 11 major industries that make up the S&P 500, what we can see here is over the 3 months, we have green everywhere. If we take and change that for, say, a month, you can see that it got a little darker, a little more red in here at different times. The last 30 days have been a little bit challenging for some of the industries, which I'm going to show you more in a second. But if we take a look at the last 5 days, we can see again, last 5 days have actually been pretty good, even though we had some pullbacks in the middle of that. If we take a look at these industries and how they have worked over the last 2 months, you can see that whether or not it's discretionary spending or communication services, technology, industrials, materials, energy, staples, healthcare, utilities, financials, real estate, all of those have done okay. Some have done better than others. We've had some that were pullbacks, but that's normal. That's how this works, is you have some asset groups that do well out of those 11 industries and some that don't do so well. Right now, we can tell that several of these, like utilities, which is a more of a defensive kind of play, we can see that technology, which has been a primary driver to the markets in general. We can see that communication services, which is also connected to technology, healthcare, and even to a point, the various S&P 500 indexes as well have continued to do well overall. Now, with that in mind, what does that look like as far as the short term with risk put into it? You can see that the areas like energy, and what you'll notice here is this negative dip. You'll also notice this line down here, which is called the relative strength indicator. When this line is below the 50 percentile, that means that we have a little bit of weakness. We got to be careful. Same thing is true here for materials, but it's kind of right at that 50 mark. Financials and staples, meaning the things that you and I have to live on, have all kind of held right there at the 50 mark there. Relative strength was worse last week. It's kind of come back a bit, and so that's a good sign. So again, all of these items make me feel confident that we could go forward here and see a really nice finish to the end of this year, depending upon what happens this year at Christmas time and as sales continue on and economic issues continue to show themselves and political issues continue to come out. We are going to see some different things happening. I think it's possible that we could actually have a pretty decent 2026 as well. But as always, proactive wherever possible, reactive whenever necessary. That's one of our mottos here that we try to work with for helping clients to manage wealth wisely, even to the point of what their goals are for creating and growing wealth. Lastly, taking a look here at the various models for our asset allocation strategies. Our most conservative models, looking at the asset allocation strategies with our ETFs, our most conservative is at 8.4 4.2, our most aggressive, as it is at 15.19. That doesn't mean that's what you receive, because, for instance, if you had some of it in the aggressive and some of it in conservative, you're going to be somewhere in the middle of that. And depending upon whether or not you had it more income oriented, you would see a lesser return than that. But comparing here for your planning and your going forward in the future, keeping in mind that these asset allocation models are how we try to build as a basis for our clients' foundational reports. And we can either get more aggressive or more conservative, depending upon how their risk tolerance factors feel. Also, I would just remind you, as I did last time, that if we take a look, this right here is the top of the most aggressive prior to the market falling after President Trump mentioned the tariffs. And that went down during that time frame about 13%. And so for some people, that would be too much. They could not handle that. Even though this number here is really good, this right here would have been too much for some people. And so again, I would encourage you, our team tries very hard to make sure that we're on the same page with you about your risk tolerance, what you can handle, what you're comfortable with. And so we try to bend the model so it matches what your needs are as well as what your tolerances are. But this should give you some ideas on how this might work. I know this is a lot of data, so that's why we're starting this education series. Let me go back to where I was a moment ago. And we'll start from here. That's what we want. There we go. So last month, I mentioned to you that I was going to begin an education series. And the reason I did that is a number of months back, we had some new attendees to the workshop. I went through all the material like I normally do. I went through the economic issues, went through the market issues, went through fundamental, technical, and behavioral analytics. And at the end of my brilliant presentation, one of the clients, one of the newer clients said, "Could you put this in regular people's terms?" And I thought, wow, that's actually very honest, very real. And sometimes it's this balance for what I do for a living to help people be able to have confidence that we understand the technical, fundamental issues we're forced to deal with on a daily basis when it comes to managing wealth wisely for families. But at the same time, my industry is full of all kinds of jargon, weird words, explanations that sometimes don't make sense in a normal daily environment. And so I began talking to several of the clients about some of these investment choices that we do and how we do them. And I began to realize that it wasn't just the new clients. Some of my clients who've been with me for years had questions about what certain investments did, how they function, why we chose them. I thought everybody understood why we did what we did. Certainly, we try our very best to make sure everybody understands why we do what we do. But sometimes I've realized that maybe we need to slow it down. And that's why I thought, especially when the markets and the economy seem to be doing well, let's take some time and do education on some items that may help people feel more comfortable with what we're doing. I also, as I was putting this together, realized there was a time when I didn't understand all these terms either. That even though I went through training and education and all of the things necessary to be in this industry, there were many pieces that I had to learn along the way. And so as I put this material together, it was really a way to say to you, you're not alone. You're not the only one who doesn't understand all these issues. And it's not because you don't have the mental capacity. It's a lot. It's just a lot. And so I began to think about how we might do some education here over the coming year to help everybody understand better and to create these as modules that clients can go back and watch, new people can go back and watch. And so some of the items I identified that we covered, this isn't all of it, we're going to do more than this, but how to use a CD, a certificate of deposit in your portfolio, how to use bonds, where you loan money to corporations or to governments to get interest on your money, how to use stocks or equities, which is what we're going to talk a bit about tonight, mutual funds, interval funds, exchange traded funds. Also, we're going to cover some of that tonight as well. Annuities, fixed annuities, indexed annuities, variable annuities, just different items that people hear, especially when they're talking to someone like me, but they might not know what that is, or they might not even know what questions to ask. And so hopefully our goal will be to make it so you have a little more understanding and confidence with that. And as I said before, there was a time when I didn't know any of this stuff either. I mean, and even after I was in business, there has been a lot of learning that I've had to do. So we're all in the same boat when it comes to this. Insurance issues, insurance. Most people don't even like insurance, except they know they need it. And so how does different types of insurance work? Property and casualty insurance, long-term care insurance, term insurance, universal life insurance, and whole life insurance. So these are items we're going to cover. I'm not going to go through this every time we talk, but I just want to remind you, this is why we're doing this. So when I put together the wealth education series, this is where we would start with this module to help people have an understanding. So especially if I recommend clients consider doing this, they have something they can go look at, maybe give them some better understanding of what this is. Tonight, as I said before, we're going to talk about investments and most specifically equity investments. But something else I found out in the course of talking with several clients, I never realized from clients' viewpoint how much we offer. I mean, most of the time you talk with somebody, they just offer stocks or bonds or cash, maybe mutual funds, or maybe they just offer insurance programs. Again, those are all fantastic. Nothing's wrong with that, but we actually run the whole gamut. We offer cash investments, bond investments, equity or stock investments. We offer real estate investments, tangible assets like energy, commodities, metals. We're able to do currency for clients that have that desire and that ability in their portfolio. We can do private equity or alternative equity programs through private businesses. We have those opportunities as well. And we have the ability to do insurance and annuities in the right situations to help clients grow wealth, protect wealth, preserve wealth, etc. So when I started to look at this, and that whoever the person I'm thinking of who said that said, we have a lot of investment opportunities here. That caught my attention. And it dawned on me that what we're trying to do here is just like this screen says, flexible solutions that focus on your goals. There's not a one size fits all. If there was, we just have one investment firm and that'd be it. They would do that one thing. But really, there's all kinds of options when you look at a person's need for growth. Some people want more, some people want less. Some people have higher risk tolerance. Some people are more risk avoiders. When you look at the need for income, how you get income from your portfolio, whether it's through bank instruments or investments, whether it's through dividends or it's through mutual funds, how do you get income? What about flexibility, the ability to change as the market changes, as your life changes? What about cash reserve, access to quick money that earns a decent rate of return, but is available to you at a moment's notice? Or what about the tax issues that connect with investments, making sure that you get to keep more of your hard-earned money inside your investment portfolio rather than paying it out to the IRS? These are all components that make it so that we need to have flexible solutions to help meet the various needs of all the clients we work with. So again, we're going to take a look at equity investment opportunities tonight, that particular piece of it, and only that piece of it. We're going to focus on 3 items. If a person says, I want to invest in the stock market, just the stock market, how could I do that? And there's more here that I could share beyond this, but again, I don't want this to get too in the weeds. But basically, when it comes to investing in equities or stocks, we can do it as individual stocks. We could do it as mutual funds or stock mutual funds, or we could do it as exchange traded funds or stock or equity ETFs. So we're going to start with individual stocks here. So first off, individual stocks, what it is you buy shares of a single company. Your return depends entirely on that one business. So you say, well, I like McDonald's, I like Ford, I like Google, I like Tesla. That's one company. You can own a piece of that company by buying stock from that company. And then your growth or your return or your loss of money will depend on the performance of that individual company. Some of the positives to that, high potential upside. If you pick a winner early, you control what you own. You don't have to talk to anybody. It's your equity. You can do what you want to with it. There's no internal fund fees. Unlike a mutual fund or even an exchange traded fund, you're just buying the company. That's it. They don't have any fees for that other than maybe what your brokerage account would require. And you can build concentrated conviction bets. In essence, what that means is you just love Tesla. And you're like, Tesla's the one I want to buy. I'm convinced it's going to go to the moon. And so you can buy a lot of that and you have control of it. You can sell it when you want to. You can buy as much of it as you want to. And that's something that as an individual you could do. We're going to talk more about whether an individual or a portfolio manager would handle it and how those two groups would be different. Some of the negatives or potential negatives to it, it's a company-specific risk and it's high. one bad earning report can wreck that stock, wreck that equity. Because if whatever company you choose, they have a bad earnings quarter, or maybe they have 2 or 3 bad earnings quarters, that can drive the value of that stock down. And what you put in could be worth less, means when you sell it, you'll have less money to pull back. Requires research, monitoring, and discipline. The ability, you've heard me talk, if you've been on our program here a few times, you've heard me talk about fundamental analysis, technical analysis, and behavioral analysis. Fundamental analysis is where all this research comes in to say, hey, is this a good company? Do they have a good future? Do they have a good management team? Do they have plenty of cash flow? Do they have cash reserve? Understanding how that company works and why it might make sense to you, that would be an important piece of that discussion. That's why the research is very important. Not only that, but technical analytics. Let's say you find a company fundamentally you like. Technical analytics is helping you decide, would I buy it today? It might be a great company, but this might not be the right time. As I was showing those little tiny charts of the various industries, you saw that some of them had lower relative strength indications. Stocks have that same ability. And so if you have a stock that has is relatively weak right now, that might not be the time to buy it. Or if you think it's just temporary, it's going to come back up, that might be exactly the right time to buy it. And that requires research, planning, and even fortitude to make the decision to pull the trigger to buy that security. So these are all pieces of when we say that the risk requires you to take time to research it, monitor it, and have discipline to get in or out. It's very hard to decide when to get in or out. I joke with clients all the time that investors only have a difficult time at 2 times when they buy a stock: when it's down and when it's up. When it's down, they don't want to sell it because they hate the idea of losing. When it's up, they don't want to sell it because they have FOMO, fear of missing out. What if it goes higher? So it takes discipline to say, I'm going to set targets. And when it hits those targets, I'm going to go ahead and make adjustments, whether I sell all of it or sell a portion of it. It requires that kind of discipline to do that. Emotion and timing mistakes are common. You cannot time the market. I can tell you that we do trend analysis trying to figure out if we think something's in a good timing, in a good cycle for it to buy. But again, everything has its pluses and minuses to it. And quite honestly, there have been times that we have, and it's not just us. Warren Buffett has talked about big mistakes that he's made. Everybody who's ever invested in stocks has bought something at the wrong time or sold something at the wrong time. So you don't worry about timing it, but you try to make sure you're getting it at a good price or you're getting out at a good price, but you don't worry about timing it as much as you just set your targets and feel good about that, because that timing is a mistake that really costs people a lot of money. And the emotions of, oh, I lost, oh, I might lose. Those are things that can slow down an investor's thoughts in this process. Poor diversification. They don't own many positions. They might own one stock, or you know what? They might own 4 or 5 stocks, but they're all technology stocks or communication stocks. They're Google, they're Netflix, they're Amazon, they're Tesla. They represent, or Microsoft. They represent almost the same industry across the board. And more importantly, when everything's going up, woo, that's fantastic. When everything goes down, that's terrifying. And so you want to make sure that you have diversified the portfolio as well by buying shares in different industries and spread out to minimize risk for the portfolio. Who's this modeling, using individual stocks? Who's it best suited for? People who want control, people who have skill or interest in this kind of research, and people who can tolerate volatility. It's almost a definition for somebody who's a risk taker. So somebody who wants to own individual securities, there's many good reasons to do it, but there's reasons not to. And you have to understand that if you're going to be that person who does it, you're going to have control of it. You're going to be able to have to deal with the volatility that comes from that. And you're going to have take time, skill, interest in doing the research for that. So you say, well, kind of like it, but I don't know if I want to do that. That might be too much. And I can tell you, after decades of doing this, we got stories. I'll going to share some of those here in a few minutes of clients who've done one or done the other model. It just depends on what you're shooting for. That brings me to the second model. Stock mutual funds, meaning a mutual fund that invests in stocks or equities. What it is, it's a professionally managed basket of stocks. You buy shares in the fund, not in the underlying companies directly, and it's priced once a day. Now, what does that mean? Well, So with your stock that you buy, whatever that stock is, we'll say it's Microsoft now. You buy Microsoft, and at 10 o'clock, it's $100 a share. And at 10:01, it's $110 a share. And at 10:10, it's $90 a share. That's various price points, and you can buy in or sell out at any time on that day. With a mutual fund, you have to wait till the end of the day, the close of the day, when the mutual fund company evaluates all the stocks, puts a price on it, and says, this is what the net asset value is today to sell out. And so you can't sell it out in the middle of the day and get a deal. You have to wait till the end of the day, and then whatever the day closed at is what your fund's going to do. That's what that means when it says it has one price per day. The pros to this, the reasons a person would do it: diversification and single purchase. Instead of having to go out and take and buy 150 stocks, you can buy a mutual fund that has 150 stocks in it. Instead of having to figure out which stocks you should buy and which industries you should get in, you can buy a mutual fund that actually has all of those choices made for you that match what it is you said you're looking for. Professional research management, especially if it's an active fund. Now there's difference. There's passive funds where they buy and hold and don't do a whole lot. And then there's active funds where they're constantly making adjustments to the portfolio based upon weighting of the different types of securities in there, or based on what they think might go up next and what they should get out of now because it's already hit its peak. Maybe they do some timing in there. There's various things that are going to happen. They usually are going to maintain very disciplined entry and exit strategies, meaning when they get in, when they get out. Those are all things that you could choose from in a mutual fund, or you might have 2 or 3 mutual funds to really diversify. They're easy to autopilot. Automatic monthly contributions. You can also set them up for automatic monthly distributions as well. So they're pretty easy to set up and to have an ongoing program with them. They're good for people who don't want to trade or watch markets. In essence, they're the person who says, I'm going to kind of set it and forget it. There's nothing wrong with that, but that's what that person kind of thinks. Now, it said a word there. I just want to kind of take a moment on that. People who don't want to trade or watch markets. So there's 2 types of people that invest in equities or stocks. They would be the trader and the investor. The trader, by that very definition, would be a person who's trading. They're buying in and out. Now, they might do it on a daily basis, like a day trader, or maybe they do it every so often. Maybe there's something called trading in the channel. There's some securities that kind of get locked into this channel where they go down a bit, and 3, 4, 5, 6 months later, they're back up, and then they cycle again through it. Maybe it's seasonal, whatever. They might trade in that regular kind of pattern, but that's a trader. That's not an investor. An investor has a longer term hold. That length of time could be anywhere from 6 to 24 months or even longer. Depends on what the investor is trying to do. But traders are constantly making adjustments, or at least regularly making adjustments. Investors are more of a buy and hold and making adjustments only when something triggers that causes them to say, I need to protect the portfolio, or I need to adjust it because of a life change I'm having, or just a big opportunity I think's out there. That's the difference between a trader and an investor. And hopefully that kind of gives you some insight for that. So some of the cons to the whole thing, the negatives: higher ongoing fees, especially for active funds. They're going to charge more to do all that work for you. So that means if they're making 10% and they're charging you 1%, that means you're going to get 9%, and they get paid that 1% for the work they did in that portfolio. Can only trade once per day. No intraday pricing. And that's what I was saying a moment ago with that stock that you could buy at 2 o'clock and then sell at 3 if you want to. A mutual fund, you sell out at 10 in the morning, you have to wait till the end of the day to find out what the price was, because it's end of the day pricing, not intraday like in the middle. They're less tax efficient. They have capital gains distributions. And what that means is sometimes inside the portfolio, the fund manager may say, I'm going to sell out of securities A, B, C, and X, Y, Z, and I'm going to distribute it out to the investors back into their portfolio or send them a check. Depends on how you're set up for that. Well, that sell of that security can generate a taxable distribution. One of the things that I've seen over the time I've been working in this industry is that you'd have somebody who'd have a mutual fund and the market would go down. Maybe their mutual fund would go down 10 or 15%. And they'd be disappointed that it went down. Certainly, who wouldn't be? And then at the end of the year, they get a tax statement called a 1099. This is, you have to pay taxes on $12,000. And they say, wait a second, my account went down. Why am I paying tax on $12,000? Well, it's because the internals of that fund, they sold out some of those securities, And then they distributed that, and that created what's called a realized gain, meaning that they took stocks that had gone up in value, they sold out of them to lock in that value. That means the investors and all the fund holders realized that gain, and then they got a tax statement. They got to pay taxes on it. I can tell you, there have been plenty of times I've seen people who were upset that the account was down and their taxes, they got hit with taxes that year. I'm not laughing because I think it's funny. I understand why they feel that way because it's one of the things that we watch for. And I'm going to talk about what that means here in a minute as well. So that can be an issue. They get tax bills when they didn't expect it. And then finally, performance depends on manager skill, not always worth the fee. Some fund managers are amazing at what they do. Most are average or not, or less. And so when you're looking at performance history, you're trying to figure out which funds to work with. Always understand that no matter what performance indicators you're looking at for a mutual fund, you're always looking at it in your rearview mirror. You're always looking at what happened. And you may notice on the prospectuses or on the material you're looking at, it says past performance is not indicative of future results. Because, it may be that the fund manager who managed it for the last 5 years did a fantastic job. Well, that guy quit, that girl quit, moved on to a new company. Now the new person comes in, maybe they're not going to be as good. Or maybe you bought it because that person is there and you're comfortable with them, and then they leave the company, but you don't really notice it. They probably sent it out in the prospectus, but you might not have read it. And so then you're like, well, why did performance change? That's part of the problem too. So you have to look at who the fund manager is, how they do it, because not all fund managers are created equal. So who is a mutual fund best suited for? People who want hands-off, investing with a managed solution and a predictable system. Now, that might sound to you like I just said, oh, mutual funds are bad. I didn't. I just said they have pluses and minuses to them. They are more predictable because they're not invested in one particular stock, but they've got a basket of stocks that can even out the ups and downs. That can make it more predictable for income. And again, if we're looking at income and growth, and if we're looking at a particular fund, we can look at its track record and say, okay, in bad times, this is how it did. And in good times, this is what it did. And so here, these are some common sense solutions that might work. So mutual funds are the second choice you do. Individual stocks and now mutual funds that invest in stocks. Now we come to the third option. And quite honestly, this is what I favor the most. I do like individual stocks. I'm not a huge fan of mutual funds. And I do like exchange traded funds, which you'll see why here in a second. But that doesn't make them right. It just means that I have the flavors I like. And so we'll talk about that now. What is a stock index ETF or exchange traded fund? It's a basket of stocks designed to track a market index like the S&P 500 or the NASDAQ 100. Trades all day like a stock, usually passive, not trying to beat the market. It's just trying to match whatever that index does. Now, a basket of stocks. So the S&P 500, and by the name you might figure it out, has 500 different companies in that index. The NASDAQ 100 has 100 companies in that index. So if you were to buy a NASDAQ ETF, you're going to have 100 different stocks in that portfolio. If you buy the S&P 500, you're going to have 500 stocks in that portfolio. That's the basket part. Now, unlike a mutual fund, it trades all day. So if you buy in at 10 in the morning and something happens weird in the market, it's going down, you can sell out at 2 in the afternoon or whatever time. Because you can say, oh, goodness, I don't want to follow this down any further. You don't have to wait till the end of the day like a mutual fund to figure out, oh, I got to wait till the end because then I can get, and if the market's really tanked, I'm in trouble. An exchange traded fund allows you to have that access more like a stock, but it also gives you that diversification because instead of buying just one company, you can buy a basket that has a whole bunch of companies built into it. It can be like an index or it can be like an industry. For instance, it could be a communications ETF, exchange traded fund, or it could be a technology or a financial services. It can be even very specific like small banks. It can be that specific in how the index is built. It just depends on what you're looking for and which fund companies will step up and create such a thing. When it says it's usually passive, what that means is you don't have to do all this research because you're not looking at one company, you're looking at a whole industry. So Ford, for instance, may be having a bad year, but Chevy may have a great year. And so you have some diversification that kind of keeps it balanced out for you, making it a little bit easier to be able to be more passive about it if you want to. Again, if you like that trading aspect, those individual stocks could be a great solution. If you don't want the the mutual fund where you're stuck and you got to wait till the end of the day, or you're really passive in it, but you want to have some control, then an exchange traded fund can help you a lot as well. So what are the pros to the index traded fund, the ETF? Very low fees. We'll go through fees here in a few minutes, but they're very low compared to mutual funds. They're not as cheap as stocks. Stocks don't have any fees like that. Mutual funds have fees, and exchange traded funds have very low fees because they're not trying to match the market. They're trying to just mirror the market. High diversification instantly, meaning again, like you buy the S&P 500. If you had money and you said, let's say you had $100,000, you want to try to buy an equal weighting of all the stocks in the S&P 500. That means you end up with very tiny numbers, but you just buy the S&P 500 index, whoo, you got all of them right there. Tax efficient, because they're not selling out securities like the mutual fund does. You're not going to have the taxes. So you're only going to have taxes off of dividends that come off of it. And when you choose to sell it to create to lock in gains you have, you might have taxes in from the unrealized gain that now is realized because you said, I'm ready to sell it now. Trades anytime during the day like stocks. You can even use limit orders, which is a special technique that if it falls too fast, it kicks you out of the account or kicks you out of that stock, that exchange traded fund. And so it gives you a measure of protection, like a break against the market falling too rapidly. Some of the negatives to it, you own the market, not selective outperformance. And so consequently, if you have a diverse group of, let's say, 100 different stocks, and you're trying to compare that to one company that's just blowing up right now in a good way, you're not going to make as much money in a diversified portfolio as you are that one company. So it's not going to necessarily keep up with that, but it should be meeting a term of return you're looking for over a short, mid, and long range thinking. Intraday trading can tempt emotional mistakes. Sometimes you get news and the market sounds terrible. Everything's going to be bad. We saw that during the pandemic. We saw that during the President Trump's tariff terror news. People were terrified and they had to get out, and that can cause people to react in ways instead of using the fundamental and technical analytics. They might just make a quick decision and get out, and then later on realize they didn't need to. And then there's some niche ETFs that have low volume and a wide bid-ask spread. There's pretty fancy financial language. Simply that you might be working with, I mentioned regional banks, for instance. Well, there might not be that many regional banks, and so it might have a higher expense ratio than, say, a large bank ETF, because those stocks trade in and out quickly. The smaller stocks may not. And so there might be a little more fees to that, and you have to make sure you've thought that through, as well as how easily you can get in and out of that exchange traded fund as well. Who's the best suited for? People who want low-cost, diversified, rules-based exposure without having to pick individual stocks. So that would be what this one is set up for. So now we've talked about individual stocks, stock mutual funds, and exchange-traded funds, which mirror indexes or particular sectors of the market or stock groups. So now let's take a look at it, kind of tie it all together. Individual stocks, diversification, very low. You got one company, or if you're going to take your money and buy yourself several companies, you're still not going to probably be able to buy as many stocks with what you have in hand as, say, a professional fund or exchange traded fund could do. When you compare diversification for stock mutual funds, moderate to high, and then stock index ETFs, usually pretty high because they're mirroring the indexes. And so, as I said before, S&P 500, they're going to have 500 stocks versus if you buy a mutual fund, they might only have part of those securities in there. Fees with the stocks, they're none. There's no annual fees for that. You'll notice there's a little asterisk, and that doesn't consider other account opening and maintenance expenses and stock trading expenses. We're going to talk about that in a second as well, but very low fees. Stock mutual funds, usually moderate to high, and then stock index ETFs, their annual fees usually pretty low. Trading with stocks, intraday, there's that new word again, intraday. You can trade anytime during the day, buy in, sell out, do it in the same day if you want, intraday. Stock mutual funds, end of day only, and then ETFs, intraday again. Tax efficiency, depends on the trades, same thing. Means that if you buy it and it goes up and you sell it, you're probably going to pay some taxes. There's also a little fancy term in there, long-term capital gains versus short-term capital gains. If you don't hold it for more than a year, you might have to pay more taxes than if you hold it for longer than a year. Again, part of that, the complications of the financial industry. But we can talk more about that on when I go through the education on taxes. We'll cover that then. Tax efficiency of a mutual fund, often poor, and then tax efficiency of a stock index ETF generally is pretty strong. Honestly, it might be fair to say that the stock index ETF would probably be similar to the stock itself, individual stock, because again, it's going to be either it's up in value, you've had appreciation or not. Now, here's a little thing that is sort of important to understand about both individual stocks and stock ETFs. So and I mentioned it earlier, called a concept called realized and unrealized gains. So let's say you put in $100,000 into an individual stock or an S&P 500 ETF. Put $100,000 in, and it's now worth $150,000. Doesn't matter what, it's just now worth $150,000. You have $50,000 of gain there. Now, surprisingly, if that is all appreciation, we're going to assume for this discussion it is. If that's all appreciation, you don't have to pay any taxes on that. You have not paid a dime in taxes on that because it's what's called unrealized. Unrealized, you have not realized it yet. Now, here's what's important about that. Let's say the market tanks, goes down 20%. That means your $150,000 is going to go down $30,000 in value. So now it's only $120,000 there. So if you sell then, you're going to pay taxes on that $20,000 of gain. You put in 100, it went up to 150, the market went down, it's now down $30,000. So now your account's at 120. You sell it, you're going to pay taxes on the 20,000. And that's going to be the same for both the individual stock and for the exchange traded fund. On the other hand, let's say the market didn't go down, it's worth that 150. You say, I want to sell out. You sell out that stock at 150 or sell out that exchange traded fund at 150. You're going to have $50,000 of gain that you'll have to pay taxes on that you've never paid tax on. You might have held that for 10 years or 2 years or 20 years. It doesn't really matter. You've never paid tax on, but you'll have to when you sell it because now you have realized the gain. Now, with that in mind, that same thing does work with mutual funds as well, but usually you're getting tax issues in the middle while they're selling in and out of positions throughout those years. So it's not quite as visible there as it is with the other two. But having said that, it's quite a tax advantage if you don't have to pay taxes on appreciation until you actually sell out of that. And then that appreciation, which was unrealized, now becomes realized. You got to pay taxes on it. And here's another part of that that's really exciting. You don't pay taxes on it at what's called ordinary tax rates. You pay it on capital gains rates, long-term capital gains rates if you held it long enough, usually over a year. And so if you've held it long enough and you don't pay those taxes on that until that time, you might only pay, depending upon your income, 15%, 20%, 10% in taxes on that money versus maybe your ordinary income rate is 25% or 24% or 20%. So the reality is that you get a benefit from this appreciation, and that's part of what that tax efficiency is about as well. Skill required, individual stocks, high, got to know what you're doing. Low on stock mutual funds, you just kind of put in the hands of somebody else, let them deal with it. Exchange traded funds, also low, but I would say it's probably maybe low to moderate is probably how I would think of it, because it does require some follow through and some watching and some technical aspects to it as well. Emotion risk on individual stocks, high. People get so connected to their stocks. It's funny. I've had adult children come in with an inheritance from a parent, and men, women, it doesn't really matter, come in and say, Daddy said we hold this stock forever. And I'm like, let's take a look at the technicals of it. It's not a good stock. But when Daddy bought it, it was a good stock, but it's not now. But emotionally, Daddy said never sell it, so we don't sell it. The other thing, and I mentioned a moment ago, is that people buy a stock, and usually when they do buy a stock, they've invested mentally. This is a good performer. I'm going to buy this. And when it goes down, they can't sell it. They usually struggle with selling it because Well, I've lost, and nobody wants to lose. So the emotions are high on that. Or the other one is it goes up. It's that same example, 100,000 goes to 150. Oh, I can't get out. Look what a great performer. It might go to 160. What am I doing? I can't get out of this. So the emotions are high. And again, after decades of doing this, I can tell you that is way more challenging than you realize unless you've experienced it. It's quite the deal. Stock mutual funds, usually the emotions are more low to moderate because they're not invested in it. They just want to make money. They just want their account to grow or to produce income. So they're not quite as invested in it. And I would say the stock index ETFs is probably more moderate. There's some involvement in there, but they're not focused on a stock. You know how we get excited about a football team or a basketball team? People get excited about their stocks like that. They're running around with pom-poms. Woo, yeah. With ETFs, they don't get so excited. It's just, I'm in the S&P 500. I don't care. So there's a little bit of an emotion there, but nothing like when they own a stock that they have put their blood, sweat, and tears into. So that kind of helps you see a little bit there. Bottom line on this is that stocks they have a high upside, a high risk, and a high involvement. Mutual funds, simple, diversified, manager run, more costly. And index ETFs, lower cost, diversified, passive, more efficient. The right choice, and hear me on this, the right choice depends less on math and more on behavior, discipline, and what you as an investor are trying to optimize for. Control, simplicity, or efficiency. I want more control, individual stocks. Simplicity, I want stock mutual funds. Efficiency, I want ETFs, index funds. That kind of helps you to see a sort of a parameter, a fenced-in area on investing in stocks. There's way more to this, and I'm not trying to imply this is everything you need to know, but it does give you a great place to start to recognize that when you're managing investments, you can do it with individual stocks. Again, talking about the stock market, not the bond market, or not cash investments, but just stocks. Equity positions in either individual stocks, mutual funds that are equity mutual funds, or ETFs, which are equity ETFs. Now, having said that, there's another piece to this that starts to make sense. And that's when we start taking a look at the fees and then how some people manage money versus how others choose to manage it. And here's where we come to the individual stocks. They usually have that zero annual expense. However, it's important to understand there are going to be fees inside the brokerage account because you usually can't just buy the stock and say, send it to my house. You're going to put it inside a brokerage account. There's going to be fees for opening the account. There's going to be a cost for trading the security. They may be very inexpensive, but it is going to be there. And depending upon how much information you want, how much access to other services that brokerage firm applies, yeah, there's very cheap, I can do it cheap thing. But then there's stuff where you want more information, more access to information, which requires a little more fee structure. And so some of those pieces are going to be there for you. So you got to look at it. But usually you're going to find individual stocks are pretty inexpensive to trade. You just got to become skilled, emotions managed, more disciplined in that process. Exchange traded funds, those fees are anywhere from 0.10 to 0.2. They sort of the average weighted and from 2024 is about 0.14. Now, if you're saying, what does that mean exactly? 0.10 is 1/10 of 1%. So on $10,000, 10% would be $1,000. 1% would be, did I say that right? Did I say 10? Yeah, 10,000, 1,000. 100 would be 1%. There you go. $10 would be 1/10 of 1%. So with that in mind, the ETFs are pretty inexpensive. 0.14 means you're going to have about $1.40 on 1,000. That's pretty inexpensive for an investment choice. Mutual funds, stock mutual funds, they come in three classes. I thought about breaking this up, but it's a little bit drawn out. I don't know if it matters as much, but you can buy them in Class A, Class B, Class C. Class A, B, and C have nothing to do with quality. It's all the same securities inside the portfolio. Class A has upfront charges. Class B has rear-end charges, no upfront, but rear-end charges, surrender charges at the end. Class C has neither upfront nor rear-end charges, but they have a higher management fee along the way. They usually range anywhere from 30 basis points to 75 basis points or 75% of 1%. Industry average is about 55%. Class B are slightly higher due to what are called 12B1 distribution fees. And Class C are the highest ongoing because they represent sort of no, you don't pay a free up front, you don't pay a surrender charge, but you do pay along the way. So the mutual fund company gets paid for the work they're doing. Now, this last piece here, managed advisory. And that's where you bring in someone like me to help manage it. Somebody who takes a look at your portfolio and then helps you figure out how to invest the portfolio based upon your growth needs, your income needs, your risk tolerance, all the things that are important to you. And they actually do that work for you. And instead of creating a general mutual fund that everybody's using, they create more specific programs matched to what your individual needs are. And we're going to talk more about that in a second as well. So that fee adds on top of it. So now, if you look at this scenario for a second, what you say is, well, I want to buy my own stocks. I don't need anybody to tell me what to do. I got this figured out. Fantastic. That's a great way to go. And for some people, that's exactly what they should do. Some people would say, well, I'd rather do these ETFs because I feel like they're more diversified and I can do those on my own. Again, great choice. Some people say, I want to do those because they're cheaper. And I also want to do stocks that are cheaper, but I'd like somebody to guide me, help me through that. Whether they're full on just giving assistance or they're actually doing all the work for you, you're going to have this bottom fee down here built into that based on the amount of work they're doing for you. So that's another piece of this. And it's not going to be like a national mutual fund that's been out there and everybody gets the same deal. It's going to be something more specific to what your needs are, more specific to your cash reserve needs, your income needs, your risk tolerance, your growth needs, your flexibility, your tax management. It's going to be more specific that way. And that's where someone who says, I don't want to do it, but I'd like someone to help me. I don't want to go to just a cookie cutter mutual fund. I really want to do something different. That's where that comes in. That last set of fees there is for that purpose. So how does that work? Well, when you look at this, there's two choices. Option A, where the investor buys a stock mutual fund, self-directed. And while it doesn't say it, they could buy individual stocks, or they could buy individual ETFs as well. And they can be self-directed. That's really the key. They're self-directed. If, again, they're doing individual stocks, one decision, one fund, instant diversification. If they're doing mutual funds, if they're doing individual stocks, they got to have more skills, more research, more time in it. Low maintenance, again, based on mutual funds, I'm going to stick with that now to keep it simple. No monitoring or ongoing decisions required. They're automatic, investor friendly, easy to set up monthly contributions and monthly distributions. No advisor fee, cost limited to funds, internal expense ratio. I have seen some advisors that use mutual funds and they do their American funds, for instance. I'm not recommending them. There's a lot of good funds, but I've seen some advisors who use very inexpensive share classes for those funds and they help manage. And so it's, again, kind of the best of both worlds, but I still would think that probably ETFs represent a better choice. Now I'm starting to get in the weeds, and this is why I don't want to go too far into that discussion, but rather than if you were to just buy an off-the-shelf A, B, or C class mutual fund, I would say you don't need an advisor for that. And that's really what my big statement is on that. But if you are wanting an advisor and you've got some particular mutual funds you like, make sure they use the very inexpensive share classes because there are some opportunities out there. Matter of fact, quite a few opportunities that can help you get that done. And they're mostly safer because they reduce over trading, market timing temptation, because an advisor is really looking at things from a different perspective, not so emotionally involved. The negatives to it, you're on your own, no counsel during fear or volatility issues in the market, no customization, one-size portfolio, not personal, tax efficiency, you're at the whim of what the fund managers are saying. There's higher internal fees, especially if it's an actively traded fund compared to ETFs, and there's no planning integration. It invests money, but doesn't manage your life, your plan, whatever else you're doing. Again, this strategy, option A, best for disciplined, do-it-yourself investors who want simplicity and don't need hand-holding or personalization. And that there's nothing wrong with that. That's a great strategy for those people who are built that way and have those skill sets. On the other hand, there are people that aren't built that way and don't have those skill sets. And that's where option B comes. A financial advisor manages a portfolio of equity ETFs and individual stocks. Professional oversight, the pluses to it, professional oversight, decisions aren't based on fear or fear of missing out. Custom strategy, risk tolerance, timeline, tax brackets, cash flows figured out, tax-aware execution, planning to look at asset allocation and charitable tax strategies that may help to minimize taxes when times come you have to do that. Behavioral protection keeps you from emotional mistakes. Holistic integration strategies with estate, insurance, retirement, distribution. Tactical shifts are possible between sectors, factors, equivalents, all the various options that are out there that you may or may not think about. And to that point, I've got a number of clients who are pilots. They're brilliant. I couldn't fly a plane like they do. I couldn't even fly a plane half like they do. But they say, you know what, I don't want to do the thing you do. And so that's where having that resource as a way to help you invest without the emotions, somebody's looking at all the options, looking at all the choices, making sure that everything makes sense for your situation. That's where that advisor comes in. To accountability and coaching, someone responsible for outcomes with you. Somebody that you're looking at and say, hey, make sure this works for me. That's what that's for. The negatives to it, the advisor fee is on top of the ETF or individual stock investment choices. Requires trust in the advisor's skills and their ethics. Are they skilled? Are they honest? Are they competent? Quality varies widely. Not all advisors add value to client relationships, and there's more complexity than a one fund solution. Who's this best for? Investors with meaningful assets, taxes, decisions, or emotions at stake who value professional stewardship and integrated planning. That's who would be looking at option B as their choice. So when it comes right down to it, you could actually break it out sort of this way. If the investor wants lowest all-in cost, simplicity, self-direction, DIY, mutual funds, individual stocks, ETFs. If they want to set it and forget it with no conversation, I would think honestly that would just be mutual funds. If they want tax smart, customized, guided decision-making and advisor-managed ETFs and stocks, and if they want partnership and accountability and planning, an advisor portfolio with ETFs and stocks is going to be the best solution. Bottom line, a mutual fund is a product. To be fair, so is an exchange-traded fund. They're products. An advisor-managed ETF stock portfolio is a process plus a partnership. You don't hire an advisor because you can't buy funds. You can. And in this world, it's even easier now than it's ever been before. You hire one because you want clarity, you want discipline, you want tax efficiency, you want stewardship, you want someone who cares about what's important to you. And over more than just your investments, you want someone who's looking out for you in what you're doing and what makes most sense for you, your family, and your future. So that brings me to this little chart that I learned years and years ago, decades ago. But it really helped me to identify when somebody comes in my office, whether it's the first time you meet them or somebody we've worked with for a number of years. The clients really seem to come in one of four categories. They come in as either a self-directed client, they come in as an event-driven client, they come in as an advisor-assisted client, or they come in as a trusted advisor client. And basically across the top up here, it's because you could identify it as low to high in professional relationship. And down here, you would identify it as assistance desired, high to low. So the self-directed person, they don't really want any professional assistance, and they don't need any assistance. They don't care about the professional relationship, and they don't really need the assistance to make it work. And that's fantastic. I can tell you that over the decades of working people, I've had dozens of people who came in, and after we talked for a while, I said, you know what, I think you're a DIY, a do-it-yourselfer. I think you got what it takes. Go ahead and do what you got to do. And if we ever can help you down the road, let us know. But I think that'd be the best path for you. I think that anything I do is just going to sound like a conflict. And so if you have that skill, you have that time, that energy, I'd say do it. And there's nothing wrong with being a do-it-yourselfer. I do a little bit of woodwork. I'm a little bit of a do-it-yourselfer. And so I could do some things, but other things I need more help on. And so I think it depends upon a person where they are to decide what they need, what makes sense. So that self-directed client, it's a fantastic opportunity, not probably for someone who does what I do, but they can certainly do a fantastic job if they stay with it and operate discipline and don't let their emotions take over and they do the research necessary. I'm going to skip to number 3, the advisor-assisted client, right down here. That's the person that wants some professional relationship and wants more assistance in what to do. They don't want someone to take over, but they want some guidance. They want someone to help them, but they don't want the whole show. They just want parts of it. And again, I can tell you, we've had a number of examples of that. I still have clients that are more advisor assisted. They just like having somebody to kind of back their play, to answer questions for them, to be there to support them. That's a fantastic choice. We're going to go to number 4 now, the trusted advisor client. That's the person that really has a lot going on. They don't want to do that kind of work. That's not their thing. There's nothing wrong with that. And they say, I want someone who will guide me, who I can ask questions, who will be there for me, who knows what they're doing. That's what they're good at. I'm good at this. They're good at that. That's that person. So high professional relationship, high desire for assistance. Number 2 now is the one that always throws me off a little bit. Now, I would say doesn't throw me off too much anymore, but there were times early on in my career when I missed it. And that's the person who has an event driving the discussion. They just got a large inheritance, or they had a situation where they received a big bonus, or maybe they got a huge tax refund. Maybe they won the lottery. I mean, there's all kinds of reasons why people have something that pulls them out of their depth, something they're not used to having to deal with. And so they come into the office and they want help and guidance. And many of those situations, we're able to help them and guide them through that period of time. It might take a half a year, it might take 2 years. But somewhere in that process, once the event is handled, then who they really are comes out. And that's great. Some of them have been DIYers. And along the way, we're like, you know what? We're glad we can help you with this, but it looks like really you're built to handle this yourself. You're built to do this. And by all means, go with God and get it done and have fun. Some of them, they come over here and they're like, I just want someone to help me along the way. I like doing parts of it, but I like somebody to guide me a bit. And some of them, and quite honestly, probably the ones that represent most of what I do, they want that trusted advisor relationship. They want someone they can count on, somebody who'll be there for them, somebody that they can ask questions of, hold accountable, guide them through more difficult times, help offset emotional issues, and make it so they can go live life, achieve their bucket list, handle life transitions, and do so in the best way possible, keep as much money on their side of the balance sheet and not going to the IRS or fees or whatever. That comes to these 2 questions right here. How do you make family wealth management decisions? That would be a clue to where you are in this. What do you want or need from a wealth advisor relationship? That can kind of tell you where you are in this matrix. And whichever one you're in, fantastic. My goal with the education series is to give you enough information, enough tools, so you could make some of those decisions, figure out where you are, where you're going, where you want to be, so you can make the right decision for you, your family, and your family's wealth. So hopefully this gives you some tools to work with to make that decision on 1, what to do with it, and 2, how to be able to measure success and what's going on with it. Now, we're going to be covering more of these kind of topics each month, and make sure that clients have an understanding of how some of these tools work in their portfolio, make sure they understand what works over here, what works over here, what makes most sense for them. I hope that was helpful for you, because that's my plan, is to make it so you have the understanding of what we're doing when we're talking to you, but even more so, you understand what you're doing when we're not talking to you, and you see your statements, or you go online, see your accounts, you have questions, that hopefully will give you some of that information so you have the confidence that makes it easy to make good decisions for you and your situation. As always, I'm going to close out here tonight with the 3 phases. These 3 phases help me to help clients understand where they are and where they're going. There's 3 phases all of us are in. We're either in the accumulation phase, which is pre-retirement. We've retired and we're in the decumulation phase, post-retirement, or you're not on this call if you are, you're in the transfer phase, you've passed away, and assets are now going to family members. So all of us, when we take wealth, every bit of wealth that we have, whether it's a lot or it's a little, works with us through and back down and then transfer to the next person. From my viewpoint, what I really want people to think about is right down here. What's your desired return on life? What is it that you want? Because when you and I are taking our last few breaths of air on this planet, we want to make sure that we feel like we accomplished our goals. Not that we had $10 million or whatever the number is, but rather that we were able to enjoy and accomplish what we wanted to. And so this phase, these 3 phases, they're all about what you want to do and helping you make sure you can accomplish it. Direction determines destination. If you're going the right direction, you're going to end up at the right destination. And if you're not going the right direction, the question be, how soon would you like to know that? so you can get back on track and get to the right destination you want to be at. That's what this financial journey is all about. Right now, as I told you, we are, for our planning clients, we're in the third trimester where we're focused on tax issues, tax planning for this year, tax planning for future years, estate design, and beneficiaries. Many of you are already starting to have our meetings. We had a few of them. We got a few more this week. We got more coming up. This is where we are. If you're a planning client, either you can call in, but we're going to call you and say, hey, it's time to come in here and do your tax review to make sure that we can minimize your outgo expense to the IRS and to the fee system and everything. That's what that's about. Next year, January to mid-April, where we start doing our planning review, planning renew. So we want to make sure that we take a look at what we've accomplished this last year, and then also take a look at what we're going to accomplish in 2026 for you. And so this is our process for our planning clients. For our investment clients, we meet one time a year just to go over investments. More often, if they have questions or if something's going on we want to talk about, we'll do that. But for our planning clients, they have 3 meetings a year to take a look at planning, investment insurance, tax, and estate. Now we are to the end. How'd I do? Oh my goodness, I'm way over. But I will take a moment for questions. If you got questions, I'm going to check here in a second. We'll do that. Goodness gracious, that went longer than I thought. Okay, so November 18th is going to be our next advisory review. Again, we're going to talk about whatever's going on at that point in time, but we're also going to focus on probably another educational event to help bring you up on some of the new ideas that I think are out there that we're using that you might want to consider, and give you the pros and cons to both. So here's what we've done. We covered market and economic update. I went through the wealth education series on equity investment options. Hopefully you can see the difference in how we create, grow, protect, and preserve wealth for our clients. That's what our goal always is. I brought you up to speed on the Fidelity transition and your questions we're going to do, and then next investor advisory. Let me just see if there's any questions in here. All right, no questions so far. I'm going to leave this up for just a second while I'm closing things out. All right, here we are. It's middle of October, Halloween, and after that, my favorite holiday of the year, Thanksgiving, where we get to take time and spend time with family. But most importantly, I like Thanksgiving because it's a time to give thanks, to think about all the stuff that's happened in the last year. Had a great year so far. Hope you're having a great year, and I look forward to how this year is going to finish out, and then all of the new stuff we got coming in 2026. So, all right, I don't see any questions. I know I'm over time. I apologize. Try very hard not to go past 6:30. Oh my goodness. All right. You know what? I appreciate you all. I love you all. You know, we're so honored by the trust that you place in us. All the relationships, which really feel more like family and friends to us. So if there's anything we can do to help you, please let us know. We're always here for you. If you have questions, you can certainly reach out by phone, 386-248-2121, or you can email Megan. For those who have my address, you can email me, but we're always here for you. And then also, if you have people you'd like to invite to our advisory review, you're welcome to do that. All you gotta do is just let Megan know. We'll send an invitation, and they're welcome to attend at their leisure. These will also be live on the website. I think we're almost caught up with everything, so that should be good. So if you need to go back and watch any part of this again, you can. Having said that, I'm done. Going to go have dinner with Jane. Have a great evening. Hope you have a wonderful evening as well, and a great week and weekend. So until we talk next, be blessed, and I will look forward to talking to you soon.